Your Credit Matters segment. I think it's a small one here. Your Credit, maybe it's not. Your Credit Matters brought to you by creditsanitizer.com. You have a credit report and it is wrong. Paying off a car loan early, does it affect your credit score? Many or all of the products that we talk about are beneficial to you. Credit Sanitizer, help you big time. Our friends at Blue Water Credit, we've arranged for them to give you a free consultation. Paying off your car loan can lower your credit score, but the effects are usually temporary. Are you thinking about paying off your car loan early, whether to free up your budget or have the satisfaction of one less monthly bill? Many consumers expect doing so will boost their credit score. Surprisingly, the opposite can occur. Paying off a car loan early can cause a dip in your credit score. Fortunately, the impact is usually short-term and may not happen to every customer. This is because other factors and variables can affect your overall credit score. While paying off debt is a good strategy for improving your credit, doing so for a car loan doesn't necessarily work the same way. We're going to give you the reasons. Why do credit scores drop after paying off a car loans? Paying off debt is indeed a strategy to build credit, so it makes sense that some people would think it's the right move for car loans. Anytime your credit history changes, such as information updates or newly opened closed accounts, your credit score can change. In the case of paying off your car loan early, it will equate to closing an account. One less account shifts your credit utilization and your credit history age. These changes may lower your credit score depending on a range of factors. It can be disappointing to see your score drop if you've worked hard to establish good credit, especially if you're balancing between the poor and fair credit threshold. In the next part, we're going to explain how car loans affect credit utilization and other variables. Car loans impact your credit score. Before choosing any type of loan, it's important to know how credit scoring works. Your credit score takes several factors into consideration, such as making payments on time, how long you've been doing so. Credit bureaus monitor and compute this data using the following weighted system. History of payments, 35%. Credit utilization, 30%. Credit history, 15%. Types of credit, 10%. That'd be mortgages, installment loans like cars, credit cards is another one. Number of hard inquiries, 10%. Listen to me on that one, 10%, one of the smallest items on there. There are certain situations where keeping debt is beneficial. For example, having a mix of open and active accounts with a strong history of on-time payments is good for your credit score. It also shows creditors you're responsible with loans should you apply for another in the future. So let's talk about prepayment penalties. Prepayment penalties are fees you'll owe if you pay off your car loan before the term ends. Some lenders include these types of penalties in the car loan as a way to still earn interest if the client decided to pay it off early. Prepayment penalties will account for a percentage of the car loan amount, which could cost you more than you paid in interest. Make sure you check the loan agreement for any prepayment penalties beforehand. Should you decide to pay off the car loan early, you got to know what to expect. What's it going to do to your emergency funds? If you pay off your car early, are you doing it out of emergency funds? Be careful of that. You want to make sure you keep some good stash of emergency funds. Making timely payments on a low interest rate car loan is less expensive than those with high rates or an outstanding credit card balance. So maybe you want to be paying off the credit cards before you pay off the car. When it makes sense to pay off the car loan early, sometimes the trade-off of a temporary credit hit is a long-term benefit. For example, if you plan on selling the car, paying off the balance to have the vehicle title beforehand can make the process easier. Here are other scenarios when paying off your car loan early is typically a good decision. To save money, to lower your debt-to-income ratio, to avoid high interest rates. The big one there is the debt-to-income ratio, because the car loan could be holding you back from buying that new house because of your debt-to-income ratio. You got to always be watching that part of it, and we want to make sure that you're in line. Now, getting that payment down to below 9 payments, that might be beneficial as long as it's not a lease. So there's a lot of different variables in there. Again, talk to our friends at Blue Water Credit, or you can talk to some of our team and give you some coaching on this as well.